Hello, everyone, and welcome to another show, Loan Officer Experience Podcast. And today we have a guest who's in the trenches, guys, not just with operations and technology. He's been doing it for a very long time. He is the COO of AFR, and he's helping lenders. He's serving lenders in the broker community. And we want to get into the nuts and bolts of operation, technology, and programs that move the needle forward in your business to help you close more clients and help those in your community. So without further ado, Michael Brenning, thanks for joining us. How are you, my man?
I'm awesome. Thanks for having me, KT. It's always a pleasure to see your handsome face and be with you and talk shop. I love talking shop. So thanks for having me on. Look forward to see you in 3 weeks.
Yeah, it's always fun for sure. Well, I always like to start shows off a lot of times with just getting to know the people that we're talking to and interviewing. I think that a lot of loan officers like to do business with people that they like, know, and trust at the end of the day. So tell us a little bit about you and your time in this industry and kind of what you've done and, what experience you've had over the years.
I'll start with the family side of things. I'm a proud father of 5. They're all mostly grown, 1 left in the house. So it's, anybody that's got anywhere north of 2 kids can appreciate what 5 kids feels like. And sometimes I feel like, I don't know when I leave work and begin at home, because a lot of it feels the same. You're tending to problems and helping people and helping them grow up or helping them grow through issues. So it feels a lot the same. My career is just, I don't want to say unique, but diverse. We'll say that. I grew up in capital markets. So right out of college, I was an intern in college, and right out of college, I was a mortgage-backed securities trader, of all things. I bought loans, pooled them, and securitized them. So I kind of started on the back end of the business. And then over my 29 years, which you can see in my beard and on my face and my hairline, over my 29 years, I've been an originator. I've run operations. I've run companies. I've founded 3 different companies. Rocket Pro TPO was called QLMS. I helped co-found that. My own 50-state wholesale lender, Heartland Wholesale Funding, right during the housing crisis, 09, 10, 11, in that era. And then I also built Amerisafe Wholesale, AWMS, as many brokers remember them. So happy to be here with you. I think of myself as kind of a jack of many trades. I'm not an expert in any one particular field, but I consider myself knowledgeable in a lot, and knowledgeable enough to be helpful to the broker loan officer for sure.
Right. Well, I love that, man. Well, thanks for sharing that. Yeah, and I'm gonna tell you, I'm a big fan of AFR. If you know me and you've talked to me, like, AFR is one of my top go-to lenders, and I just love what Rob's put together or started over there, bring you in on in the leadership as COO, but you also see the big picture. You also see the day-to-day details that go on. But what's the one operational enhancement that AFR has really put out there for loan officers, or that they're raving about? I mean, I can share too, but I'd rather hear it from you.
No, I love it. Thanks for the question. First, I'll say, in my role as COO, it's probably the most unique position I've had out of all the jobs and career stops I've had, because I get to live in the high level, big picture, where Rob and I taking the company with the rest of the executive team. And then I'll take a call on my cell phone from a loan officer who's not happy or frustrated with something or needs some clarity on or some help on something. And so I'll get into the weeds on a loan. Did it yesterday with a couple of mutual loan officers we both know and respect, that they need a little guidance and help on a few unique things they've seen. So it gives me a pretty cool vantage point, KT, to kind of see things through every lens possible, high level, in the middle, and at the bottom. And so I'd say my answer on the thing that's moving the needle most with the broker community and the new AFR, because we're on a journey, right? Rob started this thing in February of last year, 29-year-old company, but he bought an investor in and bought the former ownership out. And so we've been on this journey of modernizing everything, bringing us into the mainstream. So I'd say the biggest thing that's brought us forward is our ticketing platform. It doesn't sound like anything sexy, but it's kind of like you get an all-in-one package of the ability to open up a ticket with no points. You don't have to watch any videos or anything to open a ticket up. You can DM your main contacts. You can DM your account executive, your account manager, an underwriter, and just ask them a basic question. Or you can get really loan specific. You can be inside of a loan and ask a specific question on a condition or something you're not understanding. And then you have the ability inside of that to escalate. It's not perfect yet. We're still fine tuning it, but it's been out for about 7 months. And I'd say the feedback there has been a big game changer for our clients and for us internally. Honestly, it's how we serve the customer.
You said something that really resonates with me as an originator. You said we're not perfect.
Far from.
And I love and respect that, because there's no investor that's perfect, and there's no loan officer that's perfect. And the reason I like to recognize that when I hear people say it, is because to me, that's where trust is built, where you're able to say, hey, these are some of the challenges.
Like I love to learn. We love to learn. I think we have 6 core values. I won't share them all with you, but one of them is called be curious. And the way Rob and I explain that internally is don't walk into a conversation with a loan officer or a processor thinking you know the answer. You might think your 25 years of experience as an underwriter, it should probably pre-inform you on an answer, but go in curious because you might learn something. And I'll tell you what, I learned something yesterday. You're down in the great state of Texas, right?
Yeah.
I learned about a thing called an oilty lien. I'd never heard of an oilty lien before.
I was just talking about that the other day.
ELTY lien.
Yep.
And it deals with divorce situations. And had I not gotten that call from that loan officer and gotten to the weeds with them to solve and been curious, I wouldn't have any idea what an oilty lien is and how it solves for cash out 58-6 avoidance and all the 12-day waiting notice and all that stuff. So
yeah,
that's who we are. That's who Rob is. That's who I am. That's who our team is. And we're constantly encouraging our team to be curious and learn through the eyes of the broker because oftentimes they know more than we do. We just have to learn and be open to being wrong and and getting updated, right?
Yeah. And then when we understand that, hey, we're really good at a lot of things, like we're good, we're great, but we're not perfect, and if you need something, these are the avenues in which you have to communicate to get what you need. And like you said earlier, these are all the things and ways that you can communicate. Yeah. And
we want the feedback. Like we literally, hit the brokers are better for them. Hit us directly. Rob and I, simple email addresses, first name, last name at afrcorp.com. By the way, that's about ready to change soon. It's a little something on a name that you might want to tune in for. But we want the feedback, and no feedback is too much, too loud, too little. If you got to tweak to our process, our technology, something that you interacted with on a person, program, guideline, interpretation, something, we want it. Give it to us. Like that's who we are. Be curious.
It's so interesting too, because Rob is such a humble person. He's also very approachable.
Yeah.
He takes his business very seriously. So like if you have a concern, which I had one time and I had said something to him, next thing I know, Rob's on the phone with me and I'm like, Rob, I didn't mean to escalate it to you. And he's like, oh no, there's like we're all in this, man. And I was like, Absolutely. Dude, I love that,
We're all in this together. Absolutely. Nobody.
Yeah, because typically the, owners of, shops like this, they're almost unapproachable. Some of them are, and I just don't feel that way with Rob. I've always appreciated that about him.
Glad to hear it. I share that sentiment completely. I can approach him on anything. Some stuff's comfortable, some stuff's uncomfortable, but I know I'm always going to get the best version of Rob. So it's all good.
And now speaking of oilty liens, I can't hardly say the word.
That's hard. I'm still struggling.
I can't hardly say it. And my team literally made me say it 100 times last week. And they were laughing because I say oilty lien, like O-I-L, but it's O-W-E. So O-L-T lien. So I got it, but I just, I have to say it really slowly. But if you're in Texas, you don't know what that is, you should, because it will save your clients a lot of headache.
I learned something new through the eyes of one of our brokers yesterday.
Yep.
One of our brokers yesterday.
Yeah, it's a great thing. Yep. All right. So let's talk about affordability for a minute, because I think it's on a lot of loan officers' minds right now. What's one program or initiative that AFR has that you might feel is underutilized, but could have a big impact on a loan officer's business?
I'll talk about a few things, but I like to start with manufactured housing and modular housing. And people there's still such a stereotype out there, KT, that people still think of it as the mobile home, the single wide, they're driving past the roughed up trailer park. It's not. Like you've got Clayton Homes and all these other builders out there that are building homes that honestly, if you dropped them into a subdivision and put them next to a stick built home, you probably wouldn't even, you'd think they were just a Rambler or a ranch. You wouldn't even know that they're, or heck, you can get a 2-story modular these days or a 2-story manufactured. So, we're huge advocates of manufactured housing. We just took home an award from USDA a couple of weeks ago. We're the #1 USDA manufactured housing lender in the industry for the 3rd year in a row. We're pretty proud of that. So I think people miss out on that. Because Fannie, Freddie, FHA, USDA, VA, they all allow for it. And if you went and visited one of these new lots, whether it's Clayton or somebody else, and looked at some of the homes, they're absolutely gorgeous. You can get anything you want in them. And they come at a price point. You can pick the top of the line, absolutely most gorgeous home in the great state of Texas or where I am in Florida for like $325,000, $330,000 out the door, like absolutely to the nines with everything you want with granite or quartz or whatever you want for your countertops and just laid out. So you start there with me modular. But then I think the way Rob's brought his capital markets knowledge to the firm, we're putting pricing out, and it's been the same aggressive price since the day we started February of 24 on smaller loan amounts. And it's just not something you normally see from your average lender you're working with, right? Loan officers out there, you tend to see them get aggressive on bigger loan amounts because they're easier to make a profit on. The higher your loan amount, the less loans you have to do, the more revenue per loan. We're trying to serve America. And so we securitize loans differently, KT. We securitize them using a methodology that I'll just kind of loosely describe as a spec trade. So rather than doing these big kind of huge general pools of loans that all have different kinds of characteristics, we'll pull them up and make them look very similar to each other. And there's different bond investors out there that like to buy loans for different reasons, different stories, as we call them. And guess what they do? If you put a bunch of like-looking loans together that they like for their story, they pay up for them. And we call those spec gains. And we turn around, we pay those spec gains into our rate sheet. So it allows loan officers in Florida and Texas and the South and the Rust Belt and the Midwest and the Upper Northeast and most parts of the country, anything less than 400,000, we're going to be a market leader there by design. And that's part of our business model. And so that helps with affordability, obviously, if you're a market leader in pricing on the average VA loan, FHA loan, USDA loan, conventional loan, less than 400,000. That's all about affordability. And then, of course, never forget about Home Possible. That gets underused. Never forget about Home Ready. If you've got a client in a lower income situation, definitely plug their data into the Fannie site, the Freddie site, come to our site, plug it in, and see if they qualify for one of those two products. Because if they do, they get breaks on rate, their LLPAs are capped, and they get big MI breaks if they're going over 80%, which most of those clients are. So put all three of those things out there.
And if you're a correspondent lender, they pay very well on those.
Sure they do. Exactly.
They really do. It's insane. But
especially banks that are correspondent lenders.
Exactly. And so, one, I didn't know that you guys were the number 3 USDA manufactured home lender. Is that
number one for 3 years in a row? Those are the 3.
Yeah. 3 years in a row. Okay. So I didn't know that. And the reason that's so important for those that are listening is like affordable housing, in my opinion, is still a very underserved market even today. And you said like 325, 350 in my market, like first class manufactured home, 225, 250.
Exactly.
Like,
right.
And dude, that's great. And I'm doing them right now. And one of the very few lenders that want to do it, whether it's a single or a double, we do them. Yeah. And it's kind of, I lead with it sometimes. Of course, you got to be careful. You don't want it to be a reputation killer because sometimes those clients in the past have always had challenge credit a lot of times, but that's really, to me, that's changed to some degree.
It is. I think a lot around mobile homes, manufactured homes as homes, but also the client type that normally fits that is changing just as the homes themselves change, right?
Yeah, exactly. Yeah, that's exactly right. So we've led with that for many years, and we've been kind of an anchor in the community for those types of properties. And it has served me very well because you do that long enough, you're going to have move-up buyers eventually. And it's always a good way to build your business.
Yeah. Absolutely. Yeah. Right on.
Well, let's talk a little bit of industry insight. And the question I have is like from a bird eye's view, when you look across the broker community, what industry trend change do you think that brokers need to be preparing for like right now today?
Right now, servicing warfare, customer retention warfare at a level that's never been done before. Here's what's shifted from the last time we saw a big, rate run and during COVID, right?
Yeah.
Servicers back during the COVID era, and I'm going to be general here, like generalizing. I'm sure a few of them were prepared for it and had weaponized retention units. But guess what's proliferated? There's a big word over the last 5 years. This crazy thing called AI, and it's allowed retention units within a servicer to be incredibly data driven, incredibly aggressive, and know who's in the money, who's out looking, who's looking at for another home, they've got all this data pointing into their retention units. Now they're calling faster to your customer, not even on a trigger. They're calling your customer earlier when they're on the money. They're calling with almost money losing offers to your consumer because they want to keep that MSR, that mortgage servicing rate that they already paid up for the first time. They want to keep it on their books. It's way worse for them to lose it off their books altogether than it is to take a little bit of a loss on the new origination in their retention unit to keep it on the books, albeit even at a small loss on what they're keeping it on at. So how do you deal with that? Like the big 5, big 7 servicers are absolutely weaponized. Was out with one of our top clients on Sunday at the Bucks-Eagles game. Unfortunately, my Bucks lost. They got beat up by the Eagles. But talking with them there, I asked them, like, how often are you running into servicers now versus how often did you run into them 5 years ago? Never ran into them 5 years ago. Servicers were still being greedy, weren't ready, didn't have the tech or the discipline in place or the data in place to go after the customer. Yep. This time around, they are. And so as a loan officer out there, you've got to know that, and you've got to come up with your own strategy to be there first, be in front of your client, and probably work on your comp with your wholesale lenders. Find your wholesale lending partners that will allow you to have a refi comp plan and a purchase LPC plan, and differentiate the two, because you can't work for the same. You're not going to be able to compete with these servicers if you don't take that refi comp down to be competitive. So that's a huge, like right now, trend. It's happening with this last little run we had over the last 3 weeks. It is here. It's now. It's not going away. It's only going to get worse, and you got to be ready for it and come up with your own strategies to deal with it.
Well, I'm going to share something with you because I couldn't agree more. Listen, Michael, I'm great at follow-up. I stay in front of my database. I've been wearing them out with refi opportunities, even the lower rated ones. I've segmented my database out into, from rates and loan type and all of that stuff.
And that puts you ahead of the average loan officer already, but I can't wait for your feedback. So let's see.
I have never seen so many of my former clients either were about to refinance with the servicer, right? Or had already done it, or was like, yeah, KT, we want to refinance, but they're also getting hit up and they're like, I'm almost like I'm having to compete again. I'm like, wait a minute, man. I'm the one that gave you the dang idea to even refinance, and now you're going to shop. Like, and it's because they're doing such a good job at staying in front of them as well. So, man, and I've got loyal clients, but I had one just the other day was just like, here's my mortgage statement, work it up and send it back to me. I'm shopping it. What do you mean you're shopping it? Yeah, I'm shopping it with who? The servicers. I said, you realize I sold, we sold it to them because I'm correspondent lender. We did actually. And anyway, so it was a servicer.
I think the bolt on to that element is it's not just be ready to compete with the servicer. It's also know who you're delivering loans to from a wholesale or non-del perspective, and where the servicer goes when you deliver to them. That's half the battle. If you deliver away from the servicers that are going to immediately hunt down your clients, that's a benefit to you. That's a positive. And you can help avoid some of that. But you're going to have to sharpen your pencil no matter what. And you're going to have to be on your game with data and analytics. And to your point, being in front of your clients with email campaigns, chat campaigns, mail pieces, whatever it takes to stay in front of your clients so that they remember you when they go to refi.
That's it. Even on the retail side, because I was on retail for 10 years of my 23, and even those clients are, retail's gotten really good at being able to follow up in that way as well, which brings me to my next question. So, we always had this conversation of like retail versus the broker world. I've lived in both of the worlds, but a lot of retail loan officers and branch managers are quietly, and I say quietly, considering making a move to the broker channel. So my question is if one of them asked you straight up, why should I do this? And what am I missing? What would you tell them, Michael?
Yeah, it's, first of all, you're one of those unique characters in our industry that has, the experience you have in both channels for about 50% of your career on both sides. And I think it gives you a unique qualified perspective to ask that question. So I'm glad you're asking it. It's not a one answer, response, right? It's probably 7 different variables, and I would walk them through each variable. It's, at your current retail lender, are you struggling with product options? The one thing that one of the many things the broker community can do for you, and being a broker, is open up a vast array of lenders. Right now, you're limited to one product set at your retail lender. Whatever they offer is what you offer. You might come across a consumer that you don't have the loan program for. That's a terrible feeling. So you get product expansion and unlimited product options, almost to the point where it can become distracting. So it's both a benefit and a curse, right? Because you have to know all these things, or at least find reputable wholesale lenders that are offering all these crazy products that are out there. The product is one of these, clearly pricing advantages. I think we can say definitively that the broker community generally works for a lower margin ad nauseum than the retail community does, because of the layers of management and investments that retail companies have made. So it's a product conversation. It's a pricing conversation. Oftentimes it's a service or decisioning difference as well. Again, when you're at a retail lender, and I'm not hating on retail because I've spent chunks of my career there as well, but when you're at a retail lender, you got one underwrite and maybe an escalation path off that underwrite. If you're a broker, you can think of, hey, who's a good lender for this unique situation? Or if it gets denied at one lender, there could be a different opinion at another lender. So you have the option of going to look for different decisions and different interpretations of guidelines. So it's a third criteria. But make no mistake, like those are all positives. Each one of them has a little bit of a downside as well. But I look at product, price, and flexibility as kind of the three main drivers of being a broker. But the downsides are, at a retail lender, you don't have to worry about like E&O bonds. You don't have to worry about being insured as a company. You don't have to worry about your LOS. You don't have to worry about your CRM. You don't have to worry about sending in your call reports monthly, quarterly, annually to your different regulators in the states and the feds. There's a lot of downsides that come with having a P&L, having to share that P&L for renewal every year. What's a P&L? If you're a loan officer, like what your own loan officer P&L is, but if you're a broker owner, you're going to actually have to have QuickBooks or some kind of software to generate profit and loss statements and balance sheets and income statements. And so there's a lot of downsides. So I would say don't go into it lightly. Don't just get attracted to the shiny object of product, price, and flexibility. Do your due diligence, do your homework, talk to guys like KT that have lived on both sides and run companies on both sides, and make an educated choice. I'm obviously a little bit biased here, right? So I'm going to say I still think with all those criteria and all those caveats out there, I still think the broker community, if you're up for the extra work, pays off 10x over being in retail if you're ready to take that risk and step across the line and put the onus on yourself.
I love that answer. That was very thorough. If I had to add anything to it, I would probably have to pick technology is substantially better than what it's been. And it's really made the playing field. Actually, I would even go to say it's better, because at retail, they may limit you to the tech stack that you're able to use, in operations. Whereas
that's such a good point. Thanks for adding that on top. I mean, the reality is, you went back 5 years ago, 10 years ago, the biggest limitation or downside going into the wholesale channel, that's what KT's talking about, is you moved down in technology sophistication joining the broker community. Now I'd say it's either flat, or to your point a minute ago, you're moving up. You're moving on up with Jefferson. It's better.
And I think for so long it was like, oh, you lose control. You don't have as many options. And I think you have more control and you have more options. And I'm going to be honest, Michael, about it. Like, I feel like a customer again. I'm excited about the business again. I was one of the last of the Mohicans that left the broker world when it was down to 5%.
Right.
And it was a big deal for me to leave. And of course, I enjoyed retail. It served its purpose.
Sure.
Met a lot of people, just thought but that was the best business model, I think, in those economics. And, it was a smart play, the compliance rules changed, everything, the landscape changed, government changed it. When that happened, brokers are the ones kind of got left with the black eye. And, even though it wasn't necessarily, that's not entirely true. We sold what was available to us, but I think that the biggest challenge, if I'm going to go the other way, I agree with you. I think the biggest challenge that the broker community has right now is operations and compliance. I will say this, there's a lot of good brokers out there that you can plug into that have that dialed in. Some of the bigger names, the bigger broker shops have really got that dialed in. And, the loan officer can step in, pretty much make 100% of the money minus a per file fee and maybe a 10% admin fee to we'll take care of taxes, even though that's not a legal statement, but I'm sure. But also I think that it's being solved. I know some organizations personally, I do, that are out there solving it through a franchise model.
Oh, there you go.
Yeah. And taking care of all it, and it's dialed in. Like, it's unbelievable. It's unbelievable what I've been able to see in this franchise model from even an AIM, it's an AIM vendor relationship. And I've spent a great deal of time with this person who's getting ready to launch this at a bigger scale for the broker community. But if you could think about that, and guess what? It was less than a per file fee, compared to something. Yeah, it's great. Yeah. So you still get to have ownership in it. And I think that's a challenge with a lot of people in retail thinking about coming over. I want to own it. Well, but I don't want to do all the ownership things. Right. And
that's
so
true.
That can be, I think that's coming faster.
That is the edge. That's the big decision point right there. Do I want to take on all these things? Well, if there are new burgeoning things that you're mentioning that can solve for both benefits of product pricing and flexibility without the downside of compliance and call reports and, policies and insurance policies and all that good stuff.
Yeah, I love it. Well, in closing, man, I really appreciate your time. But in closing, I'll ask you another question. Okay. I know I'm putting you on the spot with this one.
Budweiser hot seat question. There we
go. Yeah. I already know you're a Dallas Cowboy fan. So, no, I'm just kidding.
I will be if you want me to be. Oh, I
Yeah,
can't. Yeah, no.
yeah. I'm just messing with you. Can you share one story or a broker relationship that you've had, or a moment, just anything that made you proud of your role at AFR, and how AFR is playing in this space, the broker
Yeah,
community?
love that. Love that. So I won't name names.
Okay.
It's probably not something we want to do here, but we had a broker 2 weeks ago who had taken a loan to two different lenders, gotten declined both places. Contract was running on fumes at that point. If you can imagine a purchase agreement that's been declined twice on it was a 4-week right. And they were 2.5, 3 weeks into the contract at that point, declined two different places, different lenders. And it was a VA loan. And I really think that and I'm super proud of this, I really think our core value, be curious, brought out a solution. We know that the Veterans Administration is one of the more flexible guideline sets in our industry, right? And we should be doing everything to serve our veterans like you and the many men and women that have served our country. And the VA handbook has all these different awesome trapdoors and nooks and crannies. You just got to find them. You got to be open to learning about them. And I'm proud of our underwriter that took this file in, and knew from the AE that brought it in that it was already declined twice. So they walked in like, hey, I've got to find a way to make this work. There has to be a way, because we've got a veteran and his pregnant wife with their first on the way. They're already done with their apartment. They're already, kind of getting ready to move out. They put in their notice. They've got to be out in a week, and they're not going to have any place to live if we don't put them into this house, right? And do it in a week. And we did. We found a way. We found something in the VA handbook with the help of our friends at Vetted VA, who pointed a few things out, and the loan officer that pointed a few things out. And our underwriter found a way to make it work. And we closed that deal 2 weeks ago on time. Very cool. Like, that gives me goosebumps,
That's
right?
it.
Like, any client's important to us, but a veteran that was declined twice somewhere else, the help of Vetted VA, the help of the loan officer, and the help of our underwriter, like, that's teamwork. That's why I'm in this business, dude. That's why I do this.
Well, that's what's up, man. I really appreciate you telling that story. Especially, VA's, a touchy thing for me as well. That's what we do to serve our veteran communities, is go above and beyond in that way. So thanks for sharing that. But I do appreciate you being here today, Michael, and just sharing your knowledge.
Hey, I want to leave one thing with the community.
Sure.
If you've tried us in the past, we're not the same company that we are today. Give us a fresh chance, and we're not going to be the same company in 3 weeks that we are even standing here today. So be on the lookout for some news and some exciting things coming. And thanks for having me, KT. Really appreciate you guys over at AIM.
Absolutely. New ownership, new leadership. Guys, if you're listening and you want to learn more about AFR, their programs, or maybe get plugged in with them, it's aimgroup.com. It's that simple. Check them out, get signed up. And, until next time, we'll see you on the other side.
All right. Love it. Thank you.